Okay, guys, so welcome, ladies and gentlemen, to another episode of Passive Investing in US Multifamily Show. I'm Jefferson Ortiz, and I'm here with my co-host, Jonathan Ortiz. In this podcast, we dive into multifamily real estate in the Sunbelt region and the Midwest and other parts. Now, what we do is we partner with passive investors to explore this lucrative sector in multifamily. Now, today, we are honored to pose an exceptional guest in multifamily real estate industry, Brian Wagers. With an extensive hands-on syndication experience, Brian has grown his family portfolio to 500 units and participated in over $500 million worth of apartment transactions. And then we'll get into that a little bit in depth. We're very happy to have you here, Brian. So welcome to the show.
Hey, appreciate it.
Awesome.
Brian, honored to have you here on our podcast. I'm sure our listeners are excited to get to know you. As we get the ball rolling here, Brian, could you share a bit about your background and what initially drew you into the multifamily real estate industry?
Yeah, for sure. Yeah, so when I first got started, I was in sales. So I was doing really well in sales. I built my own book of business similar to you would with your own as an entrepreneur. I went out and got customers and built that for about 3 years. I had a couple people working for me and I was maxing out my Roth IRA accounts. And I knew I had to do something with my money besides just stash it in, a 401k account. So all roads and wealth in America, from what I understood, was built through either the stock market or real estate. And I saw stock market as a quick and easy way. I saw these guys day trading online or on social media. I was like, oh, this could be a good way to do it. And I decided to start, messing around with the stock market. And I was spending so much time on stocks and it really had zero control over what was going on. It wasn't really passive that I thought it was. I was watching stocks go up and down. At the end of the day, I was losing money. And so I quickly pivoted to real estate, I saw that as more of a long-term solution and more long-term passive goal for me. So I like the tax benefits. I like the rental property investing side of it. So I did what a lot of people do, and I went to Bigger Pockets. I went, studied everything I could on their free resources, listened to every podcast I could, read every book, and I decided to start looking for single family homes. So I bought a single family home, finally found one. It was a $90,000 house. I had $25,000 saved up at the time and put that as a down payment. And that was my first ever real estate deal, I guess eight and a half years ago, before I started in the multifamily space.
Wow, that's a great one. And that's actually obviously how most people start with the single family. Now, where was this property, Brian?
This was in Springdale, Arkansas, Northwest Arkansas. That's where I sit. I'm from Cincinnati, Ohio originally. Bengals helmet in the background there, but I'm actually in Northwest Arkansas. So I've been here for about 8.5, 9 years now.
Oh wow! So you've been there for quite some time. Now that's quite a bit of a difference from Cincinnati to Northwest Arkansas. How is that so different for you? Like, what do you think are the differences?
It's been good. So I went to the University of Kentucky for school, so I slowly was moving south after Cincinnati. I was in Lexington for about 6 years and then moved out to Arkansas for the sales position. And now I'm thankful for that because this is where I really grew my personal portfolio, transitioned from single family to multifamily, went from just doing deals on my own to taking out outside investors, and then eventually got into syndication. So who knows if I would have, or what my path would have looked like if I hadn't come here. But, I definitely started in my own backyard.
Wow. Very interesting. Very cool. Awesome.
Brian, could you tell us about your very first multifamily deal and what were some of the very first lessons that you learned on that first deal?
Yeah, I just made a post about that before I got on here today. It was actually it was 7 years ago on Friday, was my first ever multifamily deal. and that was a 12-unit complex, also in Springdale. I bought it for about $500,000, so pretty good price per door, good basis. I did not, fully underwrite it correctly at the time, but it ended up, I ended up coming out pretty good on it. I got an investor to do a promissory note, so where they just gave me a 8.5% promissory note. They didn't participate in any of the upside. That was when interest rates were really low, so they thought that was a great, and they were fine to get their note of 8.5%. And I used that money to renovate the property, put some money into the parking lot, spruce up the exterior, and then renovate units as they became vacant. I had no cash flow from that property because I did not put in the full amount to turn the units. Something I learned a lot doing these smaller multifamilies was just because they're occupied doesn't mean you have to account for low repairs and maintenance. You want to account for, once these units become vacant, you also want to account for sometimes when you buy a property, especially the C-class properties that I got started a lot on when I first got started, is they may not pay rent. You may have a couple months of you having to evict the tenant. They may try to play the situation of a new owner's coming in, so they stop paying and try to see how long they can get away with that. So and also, just because someone's living in it doesn't mean that it's not a full renovation. Sometimes people are living in conditions that they have a really low rent and they're okay just living in this low rent property. They think they're not going to call for any maintenance, so their rent will stay the same. So I learned, one, just because someone's living in it, they're not going to pay, they'll pay the bills. You want to make sure they're current, and you want to account for a little bit of loss to lease when you take over. And then also you want to make sure you really get a grasp on full interior renovations as they become unit, depending on the class of real estate. So that was what I was buying a lot in the beginning, was C-class properties.
Absolutely, and I can agree with you 100%. Even like as you may know, we're here in Canada, and we bought some of those buildings, and when you come into these units and you see the condition that people are living in, sometimes there's kids involved, right? There's kids involved, and you can't help but feel bad for those kids. But like you said, they're paying low and they'd rather just kind of stay there as is. But sometimes there's literally health wise, it's not even good for them themselves. So that's a really good point.
Puts it in perspective. I mean, when you walk those units, it's almost like you feel blessed to be in your current situation and not have to do that. So it's almost motivating to, one, you're providing a better, community for the residents to live in there too, but also, to be able to purchase a apartment like that.
Absolutely, that's where all the value is. So I couldn't agree more. Now, fast forward to today, Brian. Now you and the team are managing over 500 million in assets. Like that is pretty incredible, right? That's a big number. So how has your experience from when you started has shaped your skills and mindset to where you are now? Like how different is your mindset? Obviously, I'm sure a lot different, but how much different is it from going C-class to now managing over 500 million and now going after A-class, if I'm not mistaken? Is that correct?
That's right. Yeah, we are pivoting to A-class. And I think on the mindset, it was one of the reasons why I got into multifamily in the first place, was because of the power of really teaming up. With commercial real estate, you have this large scalability component where it pays to have for a good team. Apartments in general, from single family to apartments, it pays to have a good property management. So you're already removing yourself from that layer of property management. When you're buying a multifamily property, it pays to have a good property management. Now, as you grow from, small multifamilies to syndication, which I'm doing, we're taking down 100-unit apartment complexes and up. So our last deal we're closing in December was a 200-unit townhome in Overland Park, Kansas. The deal before that was a 278-unit apartment complex in Rapid City, South Dakota. And then we did a 376-unit A-class apartment in Northwest Arkansas this year. So those were our deals this year. And having that large portfolio, you can build out asset management teams. You can have a CEO, a CIO, myself, a COO, a CFO. You start hiring out these C-level positions. because of your size. You can bill that to the property, and then you become even more efficient as a company, and you can find, bringing on these people, they can find efficiencies across the portfolio. And so from the small multifamilies, I was involved in everything. I was finding the deal, I was setting up the legal, I was setting up the insurance, I was setting up the property management company, I was talking to the broker, I was managing the construction aspect of it. Now I'm just focused mostly on the as a CIO, Chief Investment Officer, I'm focused on the equity. I learned a lot about property management, and I learned that I didn't want to be doing that my whole life. I ultimately want to be maybe on an advisory board or even full-time passive investor. That's in all my deals, I invest passively in them, because I'm slowly even further going to work myself out of the position. But going from those small, medium size, that's how I went to syndication, and we hired out those asset management positions and operational positions where I can focus more on what I like doing. And that's talking, what you guys do a lot of is talking to investors, finding out how they grew their wealth, and then how you can help them grow their wealth further while they focus on their main income streams or focus on what they're really good at. So that's a lot more fun than asking why a property manager, why, vacancy's been at a certain amount, or what they're going to do about delinquencies, or where are they at on CapEx. To me, I like doing that more personally. Now, you might have someone that likes to get into the weeds of the operations, and that's what we have on our team too, is you put those people in place.
Absolutely. I think I really like how you did everything at the beginning of your career on your own, as far as the legal side, the structure of the deal, and all that fun jazz, because it gives you an experience of what it really takes to kind of do everything as far as property management, etc. And me and Jeff talk about it all the time, about how important it is to have a really good team in your syndication team, because that is what takes you apart, I think, from other syndicators. So I wanted to ask you, Brian, what has allowed you to separate yourself from the pack?
I think, working hard is, it's a lot of the basic stuff. Maybe it sounds cheesy or it sounds basic, but staying positive, working hard, beginning with the end in mind, not thinking short term, having delayed gratification, not just taking the short term win for yourself, seeking to help others before you seek to help yourself. A lot of it is in some of those best practices for any sales or any company. You can translate that to real estate. And I think real estate is a very slow moving space. And if you can be fast and you can communicate well, you can really stand above the rest, where people may take a day or two to respond. I tried not to let anything sit. I would rather someone else be waiting on me I would rather be waiting on someone else than them be waiting. I never want to be waited on, we're waiting on Brian for this to be completed, or we need him to finish this. I always want to put it, in the else's court. So I think that can really set yourself apart in real estate, being super transparent. And that's always helped me so far and continue to help me. So.
No, I love to hear this from yourself, because I know sometimes we talk about it, mindset, staying positive, staying focused on your goals. Sometimes people hear it from us, but hearing it from somebody like yourself, to the level of success that you had it really goes to show you how important the mindset component part of it is to the business, right? Sometimes it seems like it's not anything to do with mindset, but it really has to do a lot of it with mindset, and how, you're going to come across obstacles, you're going to come across all these hurdles, but it's how you overcome them, how you handle them. And you nailed it right on. So that's awesome. Now, I wanted to ask you, Brian, tell us a little bit. I know you touched on it briefly earlier. When it comes to your partnership, how you came together with Elevate, tell a little bit about how that partnership kind of all came together. Kind of at what point of your career did it happen? I know you touched on it briefly, but I just wanted to expand on this a little bit more.
Yeah. So from that first 12 unit, 7 years ago, I grew my personal portfolio to about 88 doors, where I had no investors, no partners. I bought another 20 unit, another 12 unit, an 8 unit, another 14 unit or something like that in there. And then my investor that had started investing with me on just a promissory note saw what I was doing, and I was starting to prove this concept. And they wanted to invest with me. So we took down another 500 doors where it was just, I was the operator and he was the investor. And then I started to get family and friends involved. And, we took down about 500 doors. Biggest one was 82 units, 54 units, 20 units, 14 units, 7 units. Smallest one was 7 units, and took down, about 17, 20 deals. And just started to, I always had syndication in the back of my mind. I always knew I wanted to. That was an evolution of multifamily. Single family evolution, I think personally is multifamily or some form of commercial real estate. Within multifamily, evolving to syndication. Some people just go straight into syndication, and that can be good, but for me, I had this path, and what I was doing was working, and I was building up equity myself, building up good experience. And I started to run out of, I was playing in my own backyard, an hour, about an hour radius from myself. And I started to run out of doors. And I knew, going back to my early, readings and studies on multifamily, I knew there was power in syndication. So it wasn't like, some new concept. It was in the back of my head when I first got started 7 years ago. And once I started to run out of doors, I knew that I was going to have to either switch to different types of commercial real estate and stay in my market, or stay in multifamily and start looking at other markets. And I really believed in the power, and still do, of multifamily real estate and the fundamentals of rental property investing with the scalability of commercial real estate, the tax benefits, the scalability, the recession resistance, the cash flow aspect of it. So I just, for me to go outside of my market, I knew I needed to have a really good operational team that understood construction, that understood large apartment complexes, and that had footprints in different markets that I was interested in. And that's when I reached out to Elevate. George, we met at a conference in Dallas, and we continued speaking there. And I knew, for me, what could I do to bring benefit to them was, not being in a market, I figured I could either bring deals or I could bring equity. And for me, my trajectory, where I wanted to go, I wanted to invest passively, and I wanted to bring investors along with me. And with me having an eye for what to look out in multifamily, it was a natural progression. So I approached Elevate. They were based in Dallas. They had their own construction company. They were at a couple thousand units at a time. And we started working together on a couple deals in Texas, where I just came to them, and I did a little help on the underwriting, help with the marketing, but my main focus was on bringing my equity and my investors' equity to their deal, where I got a piece of their general partnership. And we did that on 3 or 4 deals. It went really good. The communication was good. The cadence was good. They went above and beyond what they said they were going to do. Same with me. And then I approached them to just become a partner at Elevate, to become, to really help them, on the equity side. They didn't really have someone dedicated to that. So, I was like, hey, I've over delivered on this equity side. So that they brought me in as a partner, and we've grown since then. And we're now at, 5,500 doors across the country, expanding our footprint in Arkansas. We just brought on a full-time investor relations hire. We brought on a full-time analyst. We're looking to hire another asset management position this year, and make another hire, or 2 hires in asset management this year. So really growing the foundation to, methodically grow from there.
Wow.
I love it. No, that's
awesome.
That's amazing. And honestly, Elevate is an exceptional team. And you and George look like you guys have some really great synergy together. So that's an amazing story there. I wanted to just emphasize again that I truly love your history and the real estate path that you've had, from single family to doing your own multifamily, and then to the large syndications. Because like you said, some people just jump straight into syndications, but I think once you go from A to Z, I think it sets you apart as far as knowledge, skill, partnership, etc.
Especially as an active investor. Because as a passive investor, you don't necessarily have to know, but the team is so crucial. So
absolutely. Now we know that you started in the C market, C class property asset class, and now you're more into the A asset class. So what brought you from C to A, and talk about some of the markets that you guys are investing in now or you're active in, and why you chose those markets specifically?
Yeah, and some of those properties, they may even be D properties. I mean, I had one of the first deals, one of my first investors, he was like, I won't touch that with a 100-foot pole. So I had to convince the seller to do seller financing on one of the properties because it was in such rough condition. And some of those rents started with a three behind it. They were in like the $300, like $350, $395. So you can imagine the kind of resident base there and condition you would get with that. So I guess C class would be right now they would be D class, but I think, most multifamily investors, when they first get started, everything that's out there is about value add, C class value add. And that's the easy way to add value on a C class apartment is you renovate the exteriors, renovate the interiors. You have this clear cut CapEx plan to go in and upgrade units. But we found value in these A class apartments where if we can buy them directly from developers, there's usually quite a bit of value to be added in operational expenses, pushing market rents, adding other areas for income. So we're not adding value on the CapEx, but we're adding value more on the efficiency. So without the headache, without the volatility, and recessions, sometimes C-class properties are the first to go. You start having more and more delinquent residents. You have people that are getting laid off. You have people that can't afford their rent anymore. And in the A class, you have this, continued need to work from home. That's since COVID, more people are working from home now. A lot of people want to rent an apartment that has a workspace or is a nice place to live. If they're going to be in their apartment all day and not necessarily buy their first home, which interest rates make it really hard for people to buy their first home, they want to live in a nice area. You have more people that may be living in an area only for 1 to 3 years, so they don't want to buy a home. They want to be more transient, where they can move in and out of a place. And then you have this institutional equity that used to be investing in different types of commercial real estate, office space, that now want to park their money in multifamily. More and more equity is looking at placing capital in multifamily. So then on the A class, you have more rooms for exiting. Now it's going to be other syndicators, but also you're going to have other, depending on the type of A class and market, you'll potentially have institutional equity that's coming in to look at coming in and placing money on there. So, the case study for A class has really shown us that there can be value add on this A class. And we really like the sweet spot of buying directly from developers because they want to either get out of their construction loan or they got in at a low basis. And we found a lot of value there. So, the past 18 months is when we really started to look at the A class properties and start to underwrite them that way. And now most of our transactions recently have been A class properties. Not to say we won't buy C class. We have a construction company, we're built for it. It just has to be a really, compelling case and a really home run deal for us to look at it.
Wow. No, that's really interesting. And I think, again, what John asked you earlier, what sets you guys apart is the fact that you have the construction company in-house, you have your own in-house property management, asset management. So it allows you to take on deals like that, where you take it directly from the developers because you have the background, you have the foundation to be able to take on these projects, where maybe another syndicator who only does strictly C class doesn't have the infrastructure to be able to take on those deals. So I feel like that's really what sets you guys really apart from everybody else. Because I know with the whole Elevate, you guys have a big construction. It's not like a irregular type of construction. This is a full-on construction for multifamily. So it's very specific to
right. And that's where George and Eric got their background, was in construction before they started to buy. And on those A classes, we'll have the construction company come in and build carports where, people are driving around Teslas or what have you, and they want a place to cover their car, and they're willing to pay a little bit extra a month to have covered parking. So there you're adding extra income there. We might add some EV car charging stations on the property. So now we can make more money on adding electric car charging stations. Some places we'll see if there's room to build garages and storage units, which we're doing on one of our A-class properties. We'll put in smart packages, smart locks, smart thermostats, where residents will pay a little bit more. So just getting really creative with those A-classes, which you can do on the A-class apartments.
Yeah, you won't be able to do that with the C-class because they just don't have the money, or they won't even be interested in things like that. So that's really interesting in regards to some of those things that you mentioned, lowering the overall operating expenses instead of increasing the income. So that's really interesting.
That's right. Yeah, when they're pushing that lease up, they're offering concessions, giving away free months. They're just trying to get people in the door. They're just focused on getting residents in so they can get out of their construction loan and move on.
So what's interesting, and this is something I never thought about, is that although you're buying A-class, you're still buying it from a motivated seller, to say the least, right? Some of these developers that got in trouble with some loans, good assets, nothing wrong with them, but the operators themselves, but the asset is actually good asset, it's A-class asset, which is really unique. Usually you see maybe more motivated seller with C-class, right? But that's really unique. It's an A-class motivated seller, but it's an A-class product, which is really unique. Okay.
Yeah, that's right. Yeah, exactly. They're trying to get out of their construction loan, or they already got out of their construction loan years ago and they just have a low basis. So, this year we wanted to do a deal a month, but we'll finish the deal at 3 deals this year. So, there wasn't a ton of motivated sellers, in the A-class space this year. So, we're still staying true to our underwriting and making sure that the deal pencils to our assumptions. So
yeah. No, I mean, with those big deals, that's not too shabby there. I wanted to ask you, for some of our passive investors that are going to be listening to the show, why should they invest now instead of waiting on the sidelines? What would be some of your recommendations or advice?
Yeah, Warren Buffett put it pretty correctly. The best time to invest was yesterday, and the next best time to invest is today. So I think why not invest now when you can print 15 to 20% coupons? Make sure when you're investing right now that you're looking at the correct underwriting assumptions. Make sure that you're investing, the exit assumptions are conservative. Make sure that the cap rates aren't being lowered on your exit. Make sure property insurance and taxes are going up significantly on the underwriting, not just looking at what your total return is, but looking at what are the assumptions to get to your total return. How is this person going to 2x my money in 5 years? Yeah, that's great, it says that, but what assumptions are they making about the property to get to that 2x? But for me, maybe you leave a little bit of dry powder for, good deals, but you could be waiting a long time. There's so much. I think I saw a report say there was like $100 billion in dry powder on the sidelines right now. We've only done 3 deals this year. There's a lot of people that haven't done any deals this year. So there's going to be a tug of war between, yes, there's going to be distressed sellers that did not have fixed rate debt. Maybe they got in trouble on C-class properties. There could be these buying opportunities, but there's a lot of people ready to pounce on those buying opportunities. So it's not going to be these home run deals because you have so many different buying groups that are interested in those. So it's going to keep those prices up because there's so much equity that's looking and sitting on the sidelines. And then right now, if I can make very conservative assumptions and I'm getting 15 to 20% average annual return on my money, versus putting that in a savings account where I'm getting 4 to 5%, I would rather do that all day. Inflation's at a reported 8%, probably more like 13%. So I'm really trying to do something to hedge against that inflation and put my money to work in a deal where maybe if you don't have a lot of capital, maybe you set that aside to when you're comfortable. But I don't know that for me personally, my philosophy, I'd rather hit a bunch of base hits and then some of those base hits become home runs. But if you're sitting on the sidelines looking for home runs, I know people that's like that you go to the same real estate meetup and there's someone that's been going to the same real estate meetup for 5 years, but they've never done their deal because they're so tied by analysis paralysis. They want to know every single aspect of the deal, but they haven't gone out there and just done it. You have to consider the time value of money is having that money invested now. So, I think, yes, you should be cautious about investing right now and you should have your reservations, but absolutely, I think you should be looking for the right opportunities now and start placing your capital now where you can start earning on that.
Wow. No, you nailed on so many good points there. And I really like that example you used, someone who goes to a monthly real estate event and never invests, because I know we can think of a lot of people like that. Now, what are some of the ways that you and Elevate are overcoming some of the high interest rates? What are you guys seeing how are you able to mitigate that risk of the high interest? What are some of the things that you're seeing on the market when it comes to, mitigating this risk of high interest?
Yeah, if they're existing deals and you have that floating rate debt, you try to work out something with your lender and you try to position the property to where you can get into fixed rate debt. Now, on new acquisitions, we're only going to buy anything with fixed rate debt. So that's something that, if you're doing a construction deal, you may have floating rate or, that's very risky. But for us, we're going in with fixed rate debt. We're having conservative underwriting assumptions, and we're underwriting for higher interest rates, to continue to rise. Now, if I had a crystal ball, I think interest rates at the end of next year may start coming down, maybe 2025. I think a lot of the people are saying survive till 25 is a saying in the lending industry right now. So I think 25 is when we may start to see it. Personally, I think it could start to come down at the end of next year. But making sure our assumptions are that they're going to continue to rise, that the market is going to continue to get looser when we're underwriting.
Wow. Well, that's really great, because if you can make the deal make sense in today's environment, that means that when the environment changes, how much better is that deal going to be? If you can make it work in this environment, when the interest rates come down, you're going to be sitting on gold essentially. So that's really interesting. Fixed rate, which is another really good component right there.
Yeah, and to your point there, about being ready too. The market is going to reward those who are very active in the market. If you're just sitting on the sidelines, you're not seeing what's happening on the day-to-day. You're not talking to brokers, property managers. Being active in the space helps you really see when that ship moves. Real estate is not like the stock market that is like a speedboat and can just turn on a dime. Real estate is more like a cruise ship or a yacht. It is slowly turning. It's not going to be just a quick turn. It's not a roller coaster where, but if you're active in the space, you can kind of see the tides shifting and you can be there ready. You've been talking to brokers that are active in the space. You're talking to property managers that are active in the space. You're constantly sizing up insurance. You know where insurance is going and taxes are going. So I think, being active really rewards those, when markets turn.
I really like how you put that together. The market will reward those good active investors. I like that. Brian, I'm going to ask a two-part question here as we draw towards the end. The first part of the question is, as we all started in real estate, we always got to figure out our why at the beginning, right? So we wanted to know what your why is. And the second part of the question is, if you could give a younger self some advice, what would it be?
Yeah, so my why when I first got started was just the freedom, the financial freedom, the freedom to have, money to go wherever I want with whoever I want, whenever I wanted. I wanted that freedom to, if I wanted to go jump on a plane and take my then girlfriend wherever, that's why I wanted to do it. I wanted to be able to eventually afford the nice house or the nice car if I really wanted to. I wanted to be able to retire early if I so choose to. I wanted to be able to provide for my kids and my grandkids. I didn't even have kids. I have a 9-month-old now, but when I first got started, I knew I would have kids eventually and even grandkids, and I wanted to look back. I wanted to be able to tell my future grandkids the reason why they are blessed to where they are right now is because I put in the work then, because I delayed my gratification, because I put in all this ground basis for the family legacy. So now I have a 9-month-old, and now I'm going to, he's my why, and my wife is my why. So I think the continual pursuit of the financial independence, financial freedom to be able to do what you want, when you want, with who you want. Looking back, I would tell, I think everything I did put me in this position. So I don't, buy more real estate, is probably what I would tell myself. Try to buy more than what you did before. I think that goes back to, investing now versus later. So I'm continuing with that principle, but I believe everything I did put myself here. So, talking to you guys, and I don't know that I would change much besides try to buy even more. When I
well, I can definitely say you've done really well. I mean, you've done amazing compared to, even people in Canada, like, just to kind of give you some background, people in Canada may acquire maybe 100 units. That would be like their life legacy. But somebody like yourself can do it by themselves. Now that's really impressive. So, and it's really, really good to hear your why. You have a 9-month-old child, and I see you working out a lot. So I can see health is also a big part of your life. Tell us a little bit about that. What are some of the hobbies that you like to do aside from real estate?
Yeah, I think, what's the point of having financial wealth if you can't have, physical well-being? So I'm in playing sports in high school and in middle school, and, even before that, playing football since I was 8. I always liked staying active, and I think high school sports really got me into physical fitness. So I've always been into that. So I weight train every morning, 6 days a week at 4 a.m. Part of my delayed gratification for having, put so much money back into real estate. I had a paid off car for 10 years. I had a home that I was living below my means. Now I have, the home I'll probably be in for, the next 10, 20 years. And I built a home gym, and, I had an in-law suite, or, it was a pool house, double-decker pool house. Now I was able to build a home, 2-story home gym with a sauna, cold plunge, all the weights and everything I need so I walk out in my backyard every morning to be able to do that. I like spending time with my wife and my son, try to stay active, go outdoors and travel when we can.
I love it.
That's amazing. Amazing story.
Yeah, no. I mean, anything else you want to add?
No, it's a perfect life of a syndicator. That's wonderful, man.
Now, what else did I want to add? Any last messages, any last thoughts, Brian, that you want to leave the listeners as we're kind of wrapping up here?
Yeah, I think, and people are listening to your podcast are taking the best first step, and that's getting educated, starting to get the wheels turning, really starting to grasp the mindset. I would say, don't do that for too long. I mentioned it with the, example of the real estate investor that's listened to every single podcast, that's been to every single meetup, but hasn't taken action yet. So I definitely encourage the listeners to try to take, a couple golden nuggets from each one of these episodes, but try to apply that, try to, schedule a call with these guys or someone and try to take the next step and take action.
Absolutely. You got to take action. Love it. Brian, honestly, your journey in multifamily has been incredible, and your insights. We are very grateful for your time today. To our listeners, thank you for joining us, Brian. How can our audience connect with you if they want to learn more about you? I'm sure we'll add it somewhere on the links below. But where can they find you?
Yeah, anywhere you're on social media, Brian Wagers, LinkedIn, Instagram, Facebook. I'm on the big 3, so feel free to shoot me a message there.
Awesome. Well, that's pretty much it for today. Thank you again, Brian, and thank you to our listeners for being part of this insightful episode of Passive Investing in US Multifamily Show. Remember to subscribe and stay tuned for enriching stories and insights into the world of multifamily real estate. Until next time.
Thank you, guys. Thanks, Brian.